What's going on, everybody? I'm back. Y'all been asking me to come back, so you talked me into it. So what's today? Today is Wednesday, November 16th. Markets were down a little bit. Hey, did you see this? Here's something that's really incredible when you think about it. First of all, I started thinking about this because NASA launched this rocket, the Artemis. It's headed to the moon. This is part of a mission that will be developed over a period of time to eventually put people back on the moon. But this rocket was sending back pictures of Earth, really cool pictures of Earth, while on its journey. And I mean, you see Earth, and it's not like these these close orbit pictures like from the International Space Station, or like, when Bezos goes up in his rocket. I mean, the Artemis is farther away now, so you get a picture of Earth, but then, you see the sun there in the background, and you think like the Earth is moving at 67. We're on the Earth. Like, we go around, we do our everyday, whatever we do. We get up, we go to sleep, we go about our day, we don't think anything of it. But this planet, and there's 8 billion of us on this planet, and we're moving the Earth is traveling at 67,000 miles an hour around the sun. It's rotating at 1,000 miles per hour. I mean, it's really, when you start thinking about this stuff, it's mind-blowing. Like, we don't have any concept of this. We don't have any, just like perception of this in our daily lives, but it's crazy. And we're just out here in the middle of blackness, and it's like we're in our reality here. And then there's that the solar system, the universe. I don't know. It just got me thinking when I saw those pictures. Anyway, they were really cool pictures. And I'm sure there's going to be more forthcoming from NASA. Anyway, let's talk about the markets. Kind of boring. I'll tell you, like, back in October, I said we were going to have a good October, which would lead into mid-November when we had the quarterly interest payment. That just happened yesterday. That was a net flow. Actually, a little bit less than what I was expecting. I was looking for a net, and when I say net, that is the total leading spending flow minus taxes, the tax drain, and it was like 56 billion. I thought we'd get something closer to 67 to 70 billion. I mean, 56 billion is a decent single day, and but that's it now. I mean, we don't have any more of these extraordinary, payments. We're just right back to our regular spending flows and the 4 times a month or 5 times a month of Social Security. So we're back in our normal pattern now. And I thought the flows would peak out around the level we saw in May, but we didn't get that high. So I think right now, that could be it for the rally. I'm not saying we're going to see new lows. I don't think that's going to happen at all, because, we are doing okay fiscal flow wise, in that perspective. Like I've been saying for months and months, we stabilized from the big contraction in the first half of 2022. I spoke a lot about that, and you guys know, I've been saying, none of this market correction that we had in the first half of the year, through June or September, wherever you want to call that bottom, none of this was really fundamentally related to interest rates. It was related to this record contraction in the fiscal. It was like like 1.7 trillion drained. And that was a drain that was not put back. That was a drain. Gone, kaput, out of the system. swimming pool alert. You know, that was a big, big drain of the swimming pool. Then we had to stabilize, which we did, you know, back in the period, I would say that was back in the period from like late July through September. Those flows, that drain started to subside, you know, and it was like the swimming pool finally got plugged, but the water was way, way down, okay? And then it's slowly coming back. But we're not going to get to the level that we were during the pandemic years of, you know, half of 2020 and all of 2021. But, you know, even though the water's coming in at a slower pace, eventually it fills up the pool. It just takes a longer period of time, which means you have to have more patience. Now, one of the things that I think has transpired is the fact that we have passed the inflection point. Maybe some of you remember me talking about the inflection point, and by that I meant the point at which the negative effect of interest rates, right? I mean, there is a negative effect from interest rates because it discounts net present value. Sorry. You know, when you calculate net present value, in other words, what, you know, bringing to the present what the future value of an asset is, there's variables in that. One is the interest rate. Okay, when the interest rate goes up, it lowers net present value. And the other one is cash flow. And cash flow you can correlate to the fiscal injection that is coming from rate hikes, right? We're starting to see that. And there's something very interesting, and I'll talk about that in a second. But I think we have passed that inflection point where the negative impact of the rate hikes now is less than the positive effect of the fiscal flows from, you know, those interest income transfers. Now, what I saw in the banking data, this is kind of interesting. I don't know if it's going to be the beginning of a trend. I don't know if it was a one-off, but there's been a slowdown for the first time now in a while. There's been a slowdown in credit card and revolving credit loans at commercial banks. In other words, there's been a slowdown in the growth of those loans. You know, people using credit card and revolving credit. Now you might say, oh, that's a sign, you know, people are tapped out and, you know, they can't access credit. I don't think that's what it is. I think it reflects the pickup in interest income that is being injected into the economy through the rate hikes. Now, again, I understand that not everybody participates in that. Just like, you know, if we're going to have a conversation about this, when prices come down, when you don't have inflation, which is something that most consumers would cheer, they would be happy. When you don't have inflation and prices are coming down, not everybody participates in that either. Remember, there's two sides to all of these situations. But there is a net addition of income happening as a result of the rate hikes. And my theory is, or my guess is, that this could be the reason for the slowdown in the growth of credit, because it's kind of like when the government was sending out checks during the COVID crisis. When the government was sending out those checks every week, remember we were getting a supplemental unemployment and the unemployment and then extra checks, the bank loans went way, way down. I mean, really contracted sharply. And that's because people didn't need to tap credit. They were getting those checks. They were paying for stuff in cash. The checks made them flush. And I think we might be seeing a little bit of that now. Remember, the interest income transfers into the economy. I mean, that is the same exact thing as sending out checks. It just goes to maybe a different cohort, a different, class of individuals or institutions in the economy, whatever. But it's it's the same exact thing as the government writing checks and sending checks out to people, all right? So this is my theory. This is my explanation. And we'll see what happens in the data coming up. Is it a good thing? Yeah, absolutely. I mean, if the government is adding net financial assets to the economy, that's another way of saying that the government is increasing the aggregate net worth of the economy. Like, the wealth. Net worth is the wealth. All right? When banks do it, that's not an increase in wealth. I mean, if you take out a loan, you get, you get money in your checking account, but you have a debt at the same time. You have that loan that has to be paid back starting, maybe monthly right after you get that loan. When you get an interest payment from the government or a check or whatever, Social Security check, interest transfer, interest income transfers, that's your money. That doesn't come with any offsetting liability. So is it a good thing? Yeah, it is a good thing. And it's something that I've been talking about for so long, because this is something, as you know, I don't have to tell you, but I mean, this is something that is completely and utterly ignored by the media, financial analysts, market observers, the Fed. Okay? I mean, it's just, they don't pay attention to it. They don't mention it. It's like completely non-existent to them. But it's a big deal. It is a big deal. I want you to understand that. So yeah, I think that's what's going on. But look, 1 or 2 weeks doesn't make a trend. I'm seeing it in the data. It does, but I have to say, it does seem to correlate with what I see happening on the interest income side of the equation. So it makes sense to me. I mean, it logically makes sense to me. And again, if I'm right about this, then it's just the very beginning of this happening, and it's bullish. It is very bullish. Right now, you still have to be patient, and there's going to be plenty, believe me, there's going to be plenty of bearishness and people wanting to sell this rally, and the slightest little dip or, we're still going to be at risk of headline trading with respect to comments from the Fed or something like that. So we have that going on. Yesterday, in the middle of the day, we were having a really good rally. In the middle of the day, there was news that broke that Russia had launched missiles into Poland and a couple of people died. And right away, in all the media, all the Western media, I don't know about you guys, but I follow lots of different media. And I basically tend to discount the Western media. It's all propaganda. But I try to get a smorgasbord of, information just so I can get a clearer, more objective viewpoint. If you're just going with, the Washington Post and the New York Times and Reuters and stuff like that, and, you're basically going to get the State Department, the West, the Department of Defense, the intelligence community, the establishment news. But a lot of the stuff not a lot, but some of the stuff I saw yesterday was saying that it was actually a Ukrainian missile that was fired and landed in Poland. And you could not find that view or that reporting anywhere in the Western press. And then today it comes out that the DOD, the Department of Defense, all the government, Biden himself actually said, and it was the Department of Defense, they said it was a Ukrainian anti-missile missile that was fired by the Ukrainians that landed in Poland. But yesterday it looked like at one point we were this close, to World War III. It was like Poland saying we got to, declare Article 4 of NATO, where they get together and decide what they're going to do. And it was, it was a very, this thing is a shit show. I'm sorry. And every single day we are walking a fine line between, keeping this thing as bad as it is right now, keeping it where it is, or having this escalate into a full-blown World War III, which eventually ends up in nuclear war and the total annihilation of the human race. It's no joke. This is no joke. And there was a retraction today. I don't know if it was Associated Press or Reuters or one of the big news outlets did post a retraction about their the reporting that was done yesterday about a Russian missile hitting in Poland. They said that was wrong. So it was taken back. It was wrong. And it was admitted by the Pentagon, by the U.S. Department of Defense, and by Biden. By the way, Biden, I think he even told it to Zelensky that it was a Ukrainian missile. So you got to be really, really careful about jumping to conclusions based on the mainstream media. You have to be really, and not just us that we have to be careful, because our lives are hanging in the balance. Everything is being run by these psychopaths in Washington who push forever war, and it's just getting really, really dangerous. But anyway, like I say, I try to focus on the markets. I try to focus on economics. I try to be helpful in that regard. So yeah. The other thing is we're getting really close to the debt ceiling right now. I just looked as of yesterday, we're 172 billion from hitting the debt ceiling. That's basically 5 days of government spending. So they got to do something. They got to raise it. And the whole debt ceiling thing is absolutely ridiculous. It really should be done away with. It's a ridiculous artificial constraint that has no applicability anymore to, our monetary system, which is, currency issuing nation, the United States. It's just, and we have to go through these political, these brinkmanship every time this thing comes up, and it's just it's stressful and it's destabilizing to the market. And if they don't raise the debt ceiling, there are ways that the Treasury, at least temporarily, can continue operating and making payments. All right. And that has happened in the past when the Treasury Secretary had to rely on what they call these extraordinary measures to make payments. But that can't go on forever. And it's not because the government needs to borrow money. It's because politically we have created this constraint that says, we got to raise the debt ceiling. That's just an artificial construct that, like I said, it has no applicability anymore. But it's going to be used, and it will continue to be used by both sides as a political tool, as leverage to extract whatever they feel they can extract by holding out. And now, again, we got this, basically Congress it's split down the middle, and there's going to be wrangling over this. But we can't, right now, and I'll say this, we cannot afford to have any more slowdowns in spending. Like I said earlier, we reached that bottom of the swimming pool, and it's the water level's slowly starting to come back. But now if they decide to drain it again, then yes, we will see new lows in the stock market by the end of the year. Now, I don't think that's going to happen, okay? As a matter of fact, in this lame duck Congress right now, there are some big time spending plans being put together. So let's see what happens there. At least that's what I've been hearing. That's what I've been reading. But if they do an about face on that and decide, hey, we're gonna try to eliminate the debt or balance the budget. Now we're done then, man. I mean, we're done then. But like I always say, you gotta follow this stuff as it develops. We don't know right now, and let's call it, if it's gridlock in Congress, because it's split 50-50 basically. If it's gridlock, that may be a good thing. I mean, then nothing really changes, and with these spending levels, it's going to be okay. It'll take more time to see the market get elevated. You're not going to have something like 2020 and 2021, but you'll have an upward trend in the market, and things will be okay. Anyway, that's it for today, folks. See, I came back. Don't forget, support this channel. Sign up for my report. Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. Bye.